the market returns are not equal to your returns as an investor. Don't go towards stocks. There have been so many studies that have been done that the investor, an average investor, makes much less than the market returns. In investing, your EQ is much more important than your IQ. You're not going to grow rich only by returns. You have to put in money.
If you were not able to save earlier, it will become very difficult for you to save later in life.
It's a behavior, it's a psychology. Asset class is much more important than which fund or which stock.
Honestly, tell me, is 1 crore really possible for somebody who's earning 50,000 a month? Hi guys, welcome to Aspro's another podcast today. And today's topic is really important and it's close to people, especially for salaried people. Folks who have just maybe started out and have aspirations of reaching 1 crore in corpus by a particular age number. If you are in that category where you, let's say, earn maybe 40 to 50,000 a month or even up till 1 lakh a month, this podcast is a must watch for you because the special guest that we have today is Mr. Vivek Sharma. He's head of investments at Gulaq by Estee Advisors and manages up to 1500 crores in AUM. So, hi Vivek, welcome to the podcast.
Thank you. Thanks a lot for inviting me.
Right. So, Vivek, the number one reason for calling you for this topic is because you obviously do a lot of customized financial planning, at your firm. And you guys also have a PMS, you also guys have a lot of portfolios, right? So, you know very well how to, plan financially well for your goals and how to reach that particular corpus that your particular client is looking for.
Yeah.
Right. So, to start with, 1 crore is definitely that number that is aspirational for a lot of Indians. For youngsters who are growing up, right, who just started their jobs in their mid-20s or in fact even early 30s, right? And Crorepati is a tag which, let's say, is something we have been obsessed with, right? We have seen KBC growing up, Kaun Banega Crorepati, and we can argue that obviously now even 1 crore feels a little less, but it's a very important milestone. It is
exactly
sort of that figure that where you feel that you sort of achieved something, right? Now, honestly, tell me, because you see so many portfolios, individual portfolios, and do a lot of financial planning. Is 1 crore really possible for somebody who's earning 50,000 a month, or should they just focus entirely on increasing their income? Or just to start with, is it really possible for somebody who earns 50,000 today, maybe he's 25, 28, 30, to reach 1 CR along with his existing savings rate plus whatever investments he's doing?
Yeah, I think definitely the answer is no doubt in my mind that it's not possible. Definitely it's possible. But I think the bigger factor is not what you are earning currently. The much bigger factor is what's your growth rate in salary and what part of your salary are you putting into investments. So those are two much bigger factors. You can as well maybe starting with 30,000 also. So that's not an issue really. Even people starting with 30,000, they can look to achieve 1 crore and even much higher numbers in their lifetime. Because see, you start earning at maybe 22, 23, you retire at about 60. That's the usual standard retirement age. So you are earning for about 38 years, which is a fairly almost 4 decades. It's a fairly long time. And we've seen that compounding really, if you give it time, give compounding 4 decades, it can do wonders, it can do magic, right? So that's the thing. If you are able to think long term, but give that time, don't be in a hurry. But definitely even for someone who is starting with 25,000, 30,000, for them 1 crore is not out of reach, even much higher numbers. But there has to be a plan in place.
So next obvious thing is the planning aspect of it. So how should they really plan in terms of despite whatever amount they're earning, let's suppose he's earning 50,000 or she's earning 50,000, what is the mindset that you should have and how should you be approaching your financial planning or investments?
Yeah. This is actually a pretty good formula, at least in my mind, and that's what I keep telling, that till the time your income from your portfolio is greater than what you are saving from your job, right? If it is greater, then start focusing on your portfolio. But before that, you should just focus on your career growth. So for example, let's say in the initial few years, say your portfolio is 5 lakhs
Right.
and you make 12% profit yearly on that. So that is about 60,000 rupees that you make from your portfolio,
Right.
right? Versus let's say you are able to save 20,000 per month, right? So you are saving 2.4 lakhs per month and putting into your investment account, but the portfolio as of now it's making only 60,000.
Right.
So it's your portfolio is much smaller. So just focus on your career growth, focus on increasing your income.
Right.
You're not going to grow rich only by returns. You have to put in money. So focus on your career. And the time when your portfolio gives you higher returns than what you are able to save, that will be the time you start focusing on your investments.
Right.
So for example, let's say your portfolio is now 1 crore, right? You're making 12 lakhs, but you're saving something like say 60, 70,000. So you're saving less than 12 lakhs, but your portfolio is giving you 12 lakhs. That is the time when you start focusing on optimizing your portfolio.
And now that has more potential to sort of give you those
Exactly.
kind of returns, which let's say your career growth might not be able to.
Exactly.
Right. So I think this is a great point that early in your life, what should you should be maximizing yourself, that you should consider yourself as a stock and grow that as much as possible.
Yeah.
Any tips on that, like in terms of career growth, what you would recommend as as head of investments to people, like what should they really do in order to increase their base at what they are right now?
Yeah. See, for me, there are multiple ways to do it. As we discussed earlier, one could go for an MBA, let's say, plan to go for a 1 year or 2 year MBA. Then you are taking a break, you're not earning for that 1-2 years, but you possibly by the end of your MBA, you'll be earning much higher, right? Or you could go for some sort of part-time courses, could be related to AI. But I think for me personally, what has worked best for me is work in a field where which interests you, right? Because there are lots of ups and downs in your career, in everyone's career, and today at this day and age, one has got to learn a lot, right? Keep on reinventing himself every couple of years. So if you really don't enjoy what you are doing, it will be very hard for you to grow. So personally for me, that has been the case, that try and find out the work that you really love doing. I was lucky enough that I was able to find that, even though by education I am an engineer, but markets always fascinated me. So I worked for 1 year in a software job, but after that I really took a break. For 3-4 months I searched for something that would interest me. I found a job that was in trading field and which really interested me. So I think look for something that really is of interest to you. Even though you are taking a pay cut, I think that's okay. Really. In my mind, I think that's okay, because over long run, if you work in a field which you really find interesting, you'll be able to do much more hard work, you'll be able to grow faster and come out ahead.
Yeah, I think the good mindset to have regarding this is, so we all know that like whatever listed companies that they are in the market, they go through a PE expansion.
Yeah.
Right. Similar is your career or similar is your life.
Yeah.
Right. That if let's say you take those bets early in life, where let's say you take a bit of risk, you try to explore things and you finally find out like where your work doesn't feel like work, and you don't look for like at the clock when the time is over, or you don't really have to, even if you have to work on a Sunday, it feels very natural to you. Right. You're doing it for yourself. Right. So if you're able to reach that situation, then what is eventually happening is you are beating 99% of the people, because your sort of PE expansion is happening over a period of time. You're becoming so skilled, you're becoming so knowledgeable that you sort of become irreplaceable in the market, and your market value goes up really, really high. Right?
In fact, that was the case when I told you about my first job. In fact, our second job in trading. On Sundays, we actually used to look forward for Mondays. That was the kind of interest we had in trading. That we were always, Saturdays and Sundays were really hard for us, because we wanted to get back and start trading. It really didn't feel like a job. Really.
And I've personally seen examples of some of my friends or certain people who have gone from maybe taking a pay cut or choosing a different career path where they had to compromise certain things in terms of their finances or their monthly income. But the way they have grown is from that period of time is like 100%, 200%. right? So they've seen that kind of growth. So yeah, definitely. So yeah, first part is obviously that increase your income and do all of that. But currently, let's suppose if somebody is earning 50,000 today, what is the real benchmark that they should look at in terms of their savings rate, in terms of putting their money, where should they be investing, and what time will them will obviously take certain examples, or let's say hypothetical cases in this, that obviously your salary will grow, your
Yeah.
returns will, let's say, compound, and all of that will happen. But still, let's say we were to give somebody a framework, what would that be?
So in terms of, first is in terms of how much to save, and then we'll discuss about where to save, right?
Right.
So how much to save? I think the answer is, it's very personalized answer really. For some it could be 10% is great savings rate. So 10% is just about 5,000. So
Right.
depending on your family obligations, if you're supporting your family, not staying with them, you're staying outside, paying rent, all those sort of things. So for those kind of people, it could be that even 10% is, they're struggling to save even 10%.
Right.
And for some, it could be that they're able to save very easily 50% of
Right.
their overall salary, right? So it's very hard to put down one specific number. For these kind of cases, what I suggest is save what you can. Even though the saving is very small, it could be 2,000, 3,000 or 5,000. The number is not important, the discipline, the behavior is more important here.
Yeah.
But broadly, I've seen it's somewhere between say 10% to 50% is the very broad range
Right.
that people are able to save their overall income.
I think discipline part you're absolutely bang on, because what I have seen and with my friends also is that because I have been an avid saver, my brother has also been an avid saver. The ones who have never saved, even though let's say their income was less at the time, uh, or they had certain jumps, or now they're, let's say, earning way too much, they're still used to spending 100% of their income monthly.
Yeah.
Because what I have eventually learned is if you are not able to save earlier, it will become very difficult for you to
It's
save
a
later
behavior.
in life.
It's a behavior, it's a psychology. I've seen lots of cases. Say about 10 years back, somebody was starting with 50,000 versus 2 lakh. Now 10 years down the line, the person who has been saving, focusing on his career, even though he started with 1/4 of the other
Right.
person, he's at a much better place right now versus the person who started with 2 lakhs but really is just starting his investing journey. He's obviously, his income is still higher, but the
Right.
wealth, the portfolio is smaller, and he finds it very hard right now to save in a very
Yeah.
disciplined manner.
Right.
So I think those skills are more important than actually how much you are able to save, because how much you are able to save, it's totally personalized, depends
Right,
on
right.
your
That's
personal.
absolutely fine if you have certain family obligations or certain things which, let's say, you are obliged to take care of. And but if you are focusing like on your career, and eventually you have this in your mind that you will develop a habit of saving. And if you're saving 500 rupees, 1,000 rupees, 2,000 rupees, just take it as an exercise that this is for your future, that when you'll get the right time, you'll save larger chunks, or you'll be able to save enough for your investments.
And see, people are able to save. Those people who have built that kind of behavior, that kind of discipline, when they are in their 40s. So I was just talking to a person whose salary actually, he was earning about 50 lakhs or so, and his saving was about 10 lakhs per year,
Right.
right? He got a 20% jump this year. His overall income went from 50 to 60. So 20% jump in income.
Right.
But because he was not really upgrading his lifestyle by much, he was able to save a very big part of that 10%, 10 lakhs to his whatever he is saving currently. So his savings actually went up from 10 lakhs to 20 lakhs. So that's what happens in your later part of the career, that even though your salary is increasing by 10, 15, 20%, if your lifestyle is not really increasing by that much, you are able to save much bigger. So your savings rate can go shoots up by 50%, 100% also.
Right.
So that really accelerates your journey from say 1 crore to 5 crore.
Right. So second part of the question, like where to invest, is something now.
Yeah. So where to invest? See, if somebody who's just getting started, I would want them to keep it very simple, right? don't go towards stocks. If you want to keep it really simple, index funds are very good, right? You invest in index funds. First of all, take a risk profiling survey.
Okay.
Through that, you get to know broadly. It's not very exact, but broadly you'll get to know what kind of risk you should be taking, and it will suggest you. Most of these surveys are able to suggest you.
Can you
some
tell
sort
us
of
more
asset
about
allocation.
this risk profiling survey? Like
See,
very
it just
quickly.
ask you, it will ask you very simple questions, maybe it's about 10 to 15 questions. And it will ask you about your behavior, how would you react
Okay.
given the market rises by 50% or given
Right.
the market falls by 20-30%.
Right.
These sort of questions, right?
Right.
Obviously, see, if you haven't, if you don't have the kind of the experience in markets,
Right.
you might not be able to answer it well, but still it will give you some rough idea about your risk profile, your
Right.
risk appetite, right? Using that, they are able to suggest you what kind of equity and debt allocation one should have in their portfolio. So a person who is very aggressive can have much higher equity allocation,
Right.
maybe 80-90%, or even maybe 100%. There are very few people, but if your risk appetite is there, and if you don't have any near-term goals that you are saving for, you can even as well save 100% also. But it depends on your risk profiling. So take that survey; it will give you broader debt to equity allocation. Don't think about real estate, gold, or any other. Just for starting, keep debt and equity.
Right.
Let's say it comes out to be 70-30, and you pick any index fund. Don't think too much about whether it should be Nifty 50, Next 50, or mid cap, large cap, multi cap, flexi cap. There are tons of.
Right.
First thing is behavior and discipline. So you pick Nifty 50 or you pick BSC 500 index,
Right.
and just keep investing in that
Right.
for at least 1 to 2 years.
Right.
During those 1 to 2 years, you should definitely read, learn about some bit about asset allocation. Right?
Okay.
People think most of the talk that goes on is around which stock to pick, and second most frequent one is maybe which sector, and then they talk about which fund. Frankly, these things are not as important as which asset class you should be investing in. Asset class means equity, debt, gold, real estate, all these things.
Right.
So learn about asset allocation. It's something like, let's say, if you are a sportsman, right? If somebody is playing cricket,
Right.
even if you are in top 100 in India at this point of time, a 100 ranked player would be doing fairly well financially,
Right.
as compared to somebody who is playing, say, TT in
Right.
India
And is number one.
is number one, right? So it's about which game you want to play,
Right.
So here, think of it like that only in asset allocation, that where your money is getting allocated.
Right.
Even though it's index fund, even though it might be a slightly average fund which is giving you less returns, but if it is the right asset class, then you are sorted.
Right.
So asset class is much more important than which fund or which stock or which sector, right? So in the first 2-3 years, try and learn about the asset allocation part, definitely. That is going to give you much better returns than learning how to pick stocks or learning how to pick funds.
Right.
So I think keep it very simple. Maybe take a risk survey, and based on that, invest
And
in
you can
index
take
funds.
this risk surveys online, like normally available, or
Yeah, it's very freely available. Some few ones are relatively small, which will take maybe 5 minutes. Few ones could be 20 to 30 minutes long. It depends on how much time you want to spend, but these will give you fairly decent idea about.
And I think you can take them again and again. For example, you just started out, that will
Exactly.
give you a rough idea. Then maybe 1 or 2 years later, when you experience the markets, you've seen your own behavior. I think then it will give you even a better picture.
And your risk appetite also keeps changing.
Right.
I've seen this personally with myself. Initially, I was a trader. My risk appetite was higher in trading. But when I used to invest like I'm a trader only. It is not a long-term investment sort of a
Right.
thing.
Right.
So I would say in investing, my risk appetite was not really very high. So if I have invested something, if the market goes down by 5-10%, I'll just exit. Right? Now it's totally different frame of mind, because I have seen the markets. Obviously, I've seen last 20 years of market, and I've read a lot about what has happened in the last 100 years, 200 years, all those sort of things. So that has given me a much better perspective on risk.
Right.
That is one thing. my knowledge, and secondly, I am financially much better placed right now to take these kind of risks, because of which now my risk appetite is way higher than what it was when I started out. So your risk appetite, your risk appetite actually keeps changing every few years or so.
Right. So I think you raised one important thing, and I would like to discuss on that further. So guys, we'll go into the calculations and everything. We'll show you on the Excel sheet how you can plan those numbers with your salary growth and everything. But like you said, you have read, the history a lot about the markets, about various other countries also maybe, and India also. Like you said, 100 to 200 years of sort of data. What have you eventually learned out of that? Like, what are some of the wisdom pearls like you've seen? If you were to list them down, what is eventually the crux? Because the thing is, like you said, even though you also started with trading with not a long-term view, right? You also made your mistakes, right, in terms of savings or asset allocation or whatnot. And everybody's journey more or less like this, right? This journey teaches you a lot, right? So, but the problem that becomes is that whoever is young or is starting out, they might end up making too many mistakes where they get burnt so much that they'll not be able to recover, or let's say, जैसे हम हिंदी में बोलते हैं ना इंडिया में कि दूध का जला मतलब फूक फूक के पीता है, whatever that quote is.
Yeah.
So, in order to save people from that, because people who are young, what would you sort of give them sort of the wisdom book from your end?
Okay, see, I'm still learning.
Right.
There's still so many mistakes I make. Still, I feel like what happened with gold.
Right.
I started investing in gold, but I was not nearly as aggressive as now. So there are definitely few things that I would learn and try and improve. But yeah, I think overall reading books and last 20 years has really now helped me with few of these lessons. One thing is, I think your intelligence plays a much less role than your EQ. So here, at least in investing, your EQ is much more important than your IQ.
Right,
So
absolutely.
your hard skills, which people realize very late. Even when I was in trading, I saw it very clearly that the people whose understanding of markets in terms of technical skills, technical analysis or fundamental skills was not as great, but because they were able to control their emotions, they were a much better trader. And that's the same thing I've seen in investing, and even in algo trading or algo investing or systematic investing, which we practice at Estee and Gulaq. I've seen that time and again, that following a system is also very hard for people. Even though systematic investing should be very easy for someone, but following those rules during the market's ups and downs is very hard for even algo traders, systematic investors, let's call them. Right. So your EQ, focus on that EQ much more than you focus on IQ.
Right, and I think this is a special problem with men in particular, like because रोज कुछ न्यूज़ पढ़ रहे हैं, आज कुछ ये अनाउंसमेंट हो गई है, आज कुछ ये हो गया है, आज कुछ वो हो गया है. So we focus on a lot of these variables and we forget what eventually the goal was.
Yeah. And this is true, because see, if you look at your let's say market returns, market has given last 10 years about 12 to 15% depending on any index that you pick, in that range, right? How many investors do we know who have made 12 to 15%, which is a very good number actually. Over 10 years, if you keep making, and this we'll see in this Excel also. So the market returns are not equal to your returns as an investor. It depends a lot on your behavior, and there have been so many studies that have been done that the investor, an average investor, makes much less than the market returns, which means the leakage is about 2 to 3%, and that's very popularly known as the behavior gap. What you make as an investor versus what market is giving you. So if the market has given say 12%, most of the investors would be in the range of 9 to 10%. They'll be losing that 2-3% because of the bad behavior. And when we talk about bad behavior, the things are not very difficult. They're easy to understand, but difficult to practice. They're very difficult to implement.
Correct.
Right. And those are everyone. I'm sure everyone would have heard about these things. That SIP. Don't try to time the market. Right. if you keep investing regularly every month, that's a much better strategy than when you try to time the market.
Right.
Don't try to pick stocks. I think if you invest in mutual funds, that's a very good way of building long-term wealth, really. Right? So these are very simple things. It's very hard because, as you rightly said, when you keep hearing on social media, on TV news channels, different news, either positive or negative, you obviously get influenced by them a lot, right? And hence you want to maybe come out ahead, you want to make better decisions, you want to make higher returns, and then you try and indulge in things like stock picking, timing the market. But if you really stay away from them, you'll do just fine. You'll do much better than say 80 to 90% of the investors.
Right, absolutely. Right. So I think what we can do next is we can sort of jump into that Excel that we want to show to people, like how much savings, how much wealth you can generate, and what at salary growth assumed, what kind of returns you can eventually make by a certain age.
Sure, let's go ahead.
So yes, Vivek, I think we can start with this. We have the sheet in front of us. So guys, we'll show it to you on the screen here, and we'll walk you through the entire roadmap.
Okay, so Vishwas, first thing that I want to share is what we discussed earlier about salary growth. Why is that so important? Now, many people would have seen other sort of simulations ki how does market return impact your portfolio. But I think first thing is, this is something I definitely want to show. So what I've done is I've taken here 3 cases. In all these 3 cases, somebody who is at 23 starting with a salary of about 50,000 per month, right, which leads to a yearly salary of 6 lakhs. In the first case, his salary is growing at 8%. In the second case, it's growing at 12%, and in the third case, it's going at 15%. Now, I think most of the viewers would agree that this specific factor, how your salary is growing, at least you have a much better control on this, if not 100%, maybe it's 70-80% than on market returns, right? So this is in your control. So now let's see when you are 40. So in about 17-18 years time, where your salary would be. So somebody whose salary is growing at 8%, he would reach an annual salary of 22 lakhs versus somebody whose earnings are growing at 15%. His annual salary would be 64 lakhs. So that's the kind of difference. Almost 3x.
Yeah, that's a very important factor.
And this is where the wealth will be created. If a good part of it you are increasing and you are saving a good part of it in investments, which is again growing at say 12%, that's where the wealth will be created, not only from markets, it's how much money you put in markets. So this is the first thing that I wanted to share with you. Okay. Now secondly, we were discussing that how much one should need to save, and one thing I wanted to show is even a 5,000 saving per month is good enough to get started if somebody is able to do consistently. Now this is all Excel. I think the numbers would make sense, and we can talk about why for most people this won't translate it to reality, right? So somebody who's starting with a monthly salary of 50,000, saving monthly 5,000 rupees, which is saving yearly 60,000, which is just 10% of his total earnings, right? So at that pace, and here the assumption is that your salary is growing at 10%, right? And your savings rate, I've just assumed the same at 10% only. So whatever your salary is, you're able to save 10% of that. So here, Vishwas, what I have assumed is your portfolio is growing at 12%, which means this will happen only if you are almost 100% in equity. It's very hard to get, maybe if you're just 60% in equity, 40% in debt, it's very hard to get this 12% kind of returns. Right. And obviously, people using this Excel sheet can change these parameters and they'll be able to play around with these numbers. That's one assumption. Second assumption is your salary growth is 10%, and your savings rate, as I've assumed that constant at 10%. What I explained is earlier, in your 30s, maybe in your 40s, your savings rate can increase drastically. Right. That's what actually I've seen happen. So now looking at numbers, this is the year-end portfolio. You're reaching about 1 crore in 20 years from when you start saving. So about 2 decades it will take you to reach that 1 crore milestone, but it is possible. And here if somebody is starting at say age 23, he would be about 42, 43,
Right.
right? So still he'll have about 18 years in front of him,
Right.
right? And let's see where he'll be when he'll be able to reach from 1 crore to 5 crore. So that's about in his 50s, early 50s, age 53, 54, he'll be actually be able to reach about 5 crores
Right.
in portfolio. So you see, I think this is quite interesting that people assume that in your journey to say 5 crore, the midpoint is 2.5 crore.
Right.
But that's not the case. If you look at it in terms of time,
Right.
when you reach that 1 crore, maybe you have done about 60, one third of the time, right?
Right.
So 50 to 60% of the journey is actually over in your journey where
To
you're
5
trying to
CR.
reach that 5 CR.
Right.
Now we can obviously do these, we can go to sheet 3, which in which the assumption is broadly the same here. What I have just assumed is you're starting with a savings rate of 20%, which is you're saving monthly 10,000 rupees,
Right.
right? Another change that I have done here is whatever growth here, if you go to this formula,
Right.
so what I have assumed is whatever growth in your salary
Right.
salary growth is still 10%.
Right.
But here what I have assumed is your growth in salary, the incremental growth, half of that
Is also in your savings.
is in your savings,
Right.
right? So if you take that,
Yeah,
then
so-
by the year 13 or 14 maybe, you will
Yeah,
be able
13.
to reach. So here your savings rate is very, very high,
Right.
right? Your savings rate is starting from 20% and it's moving to maybe 40%.
Yeah.
Right. But by your 13th year, you will be able to reach that 1 crore mark, and by the year 22 or 23, you will be reaching that 5 crore mark. And that why that 5 crore mark is important is after your 5, when you reach that 5 crore, most likely every year you will be able to add at least a crore.
Yeah.
Because at 5 crore, 12% growth, 60 lakhs, anyways, you are just
Right.
making from your portfolio. And if you are able to save another 20, 30, 40, you are almost there. So after that 5 crore, every additional year you would be able to make about a crore. So 5, 6, 7 crore, then the growth really starts, then you start seeing the effect of compounding. So those are the things that I wanted to show and share with you.
Cool. I think what we have learned from this is that just small levers that you put in, right? Like your savings rate that you're starting out, or your salary growth numbers.
Yeah.
Even a 1% or a 2% change might look small today, but in the period of 10 to 15 to 20 years, it really becomes magnificent.
Yeah. See, in that 1 to 2%, both in terms of your returns also can impact a lot. But only thing is control what you can control. Returns, market returns are not in your control. But your salary growth, how much money you are putting in, for how long you are staying invested, these things are in your control.
Absolutely. So Vivek, what we, a clear pattern that we saw in these calculations was, and I think that is where a lot of people have concerns, or let's say they get really frustrated, is that when you're starting to do SIPs, right? And obviously not everybody has that opportunity of doing a lump sum investment where you'll see sort of that growth fast, right? When you're doing SIPs, obviously it's like, putting one brick at a time, right?
Yeah.
And you don't really see that growth, especially if markets have been volatile. It can really take you to see the visible impact of SIP, let's say in the year 3 or year 5, right? So people feel that returns, market returns maybe beat nahi ho rahe mere mutual fund ke, what let's say other fund might have given. So they might think of switching funds because of past returns or recent returns, right? And largely this has been the selling point of not just mutual funds, but of all, I think, investment products, that we are always chasing the returns, right? The hottest returns wherever are available. So what kind of advice would you give to people in that aspect?
Yeah. I think this here we are talking about compounding slightly, that initially in the first few years, there's no visible growth really. You don't really feel that you're making that kind of progress to reach 1 crore or 5 crore in the first few years. But I think that's always been the case with not only investing, but anything that is worthwhile achieving in life takes time.
Right.
Whether it's good health,
Right.
that you start going to gym, I think the principles are really clear that you do any kind of workout and you eat healthy.
Right.
Still people struggle with keeping good health, right?
Right.
And I think it takes a lot of time. 1 week, 1 month, you're not going to see any visible improvement in your health really.
Right.
It takes few quarters at least. Definitely with years, with 1, 2, 3, 5 years, the compounding actually shows, right?
Right.
It could be in your career also. Within few quarters, you really won't see that, but if you keep working hard for few years, you'll see those results.
Right.
And I've read this quote quite a lot, that in the short run, right, whatever you expect a lot, but
Yeah.
you are unable to get that kind of growth, right? So you are overestimating what you can achieve in short term, and you actually underestimate what you can achieve in long term. So,
Right.
and we have seen this in Excel, that even reaching 5 crore is possible if you
Yeah.
start with 5,000 SIP, if your growth is good,
Right.
right? So that's what I have to say, that over long run you really underestimate, and in long run you overestimate what you can achieve. So you've got to keep patience. It's hard, it's not easy, but you have got to keep patience. I don't think there's any other way. In fact, if you try to move faster, which is by shifting funds, or maybe going into FNO trading, or trying to time the markets, these faster ways are actually slower ways. They'll actually slow down your growth in compounding a lot. So don't indulge in those kind of things really.
Right, got it. Thank you so much, Vivek. I think you've given a very good framework, and also the kind of mistakes people should avoid and you've shown a very clear possibility and a roadmap as to how people can achieve 1 CR even if they're starting with whatever base salary that they have, and what are the kind of principles you need to follow along with them. So thank you so much for coming here today.
Thank you, Vishwas. It's always good to speak to you.
Thank you so much for coming.